welcome to the deep dive. Today we're going to be looking into the trade desk, ticker symbol TTD.
Right.
They're a big player in programmatic advertising. And this topic actually comes from an article sent in by one of you listeners, which is great. It's from the Motley Fool.
Exactly. And the article poses the central question. Did the trade desk already see its best days? Especially after what the author calls a recent stumble.
A stumble.
Yeah, but the interesting part is the author argues pretty strongly against that idea. So our mission today is really to unpack that argument. What's the reasoning, and what does it tell us about ad tech, and maybe TTD's future?
Okay, sounds good. And maybe just quickly for anyone less familiar, programmatic advertising, what's the quick definition?
Good point. Basically, it's using tech algorithms to buy and sell digital ad space automatically. So no manual back and forth. It happens in real time.
Got it. Automated ad buying.
Yeah.
So let's talk about this stumble the article kicks off with. It mentions a really impressive run before that, right?
Oh, absolutely. I mean, up until the end of 2024, the trade desk had, get this, 32 straight quarters where they beat their own guidance.
32. Wow. That's consistency.
It really is a long stretch of predictable outperformance.
So what happened? What was the surprise that broke the streak?
Well, the surprise was they recently missed expectations, both what analysts were forecasting, the consensus, and maybe more importantly, their own projections, too.
Ah, okay. So a double miss.
Yeah, and that was definitely a break from the pattern. The article makes it clear, the market noticed.
How did the market react? What did the article say there?
It reacted pretty strongly. The stock price took a big hit. The article mentions it lost over 60% of its value at one point.
Oof, over 60%. That's significant. Signals real concern.
Definitely. A sharp drop like that shows a big shift in investor sentiment after that quarter.
Okay. But the article, as you said, argues things turned around. What's the evidence it presents for that recovery?
Right. This is where the narrative shifts. The piece really zeroes in on their first quarter results this year. They showed a pretty strong rebound.
Okay.
Revenue hit $616 million. Now, that's 25% growth compared to the same quarter last year.
25%. That's solid growth.
It is. And what's interesting, maybe even more telling, is that growth actually accelerated. It was up from 22% year-over-year growth in the quarter just before, in Q4.
Acceleration. That's usually a good sign. What about profitability?
Also strong, their adjusted EPS earnings per share, that came in at $0.33, which was a 27% jump year over year.
Okay, so solid numbers. How did that stack up against what people were expecting for Q1?
That's the key part. They didn't just meet expectations, they blew past them. Analysts were looking for around $575 million in revenue and 0.25 cents for adjusted EPS.
So quite a beat, then.
A significant beat, yeah, on both top and bottom lines.
So what does the article point to as the reason for this turnaround? What's driving it?
The main driver, according to the author, is their new platform. It's called Kokai, and it's infused with AI.
Kokai. Okay.
Yeah, its adoption seems to be picking up steam, and that's presented as really central to this rebound story.
AI infused.
Oh.
What does that mean in practice? What does Kokai actually do?
Well, it gives advertisers better tools for making decisions about where to place ads, and also for measuring how well those ads are actually working.
And the scale is impressive, I gather.
It's huge. The article mentions it can access something like 13 million ad impressions every single second.
13 million per second. That's mind-boggling. How does it even manage that?
Well, that's where the AI comes in, right? It processes that incredible volume of data in real time. It analyzes patterns, predicts which ads will work best for which audiences, essentially optimizing constantly.
Something a human team just couldn't do at that speed or scale.
Exactly. It's like having this super intelligent system fine-tuning your ad spend nonstop.
So for the advertiser using it, the benefit is better results for their money.
Basically, yes. It helps them buy the right ad inventory at the optimal price to reach the specific people they want to reach right when it's most likely to have an impact, maximizing that ROI.
Makes sense. Now, the article did mention that earlier stumble, the Q4 miss.
Yeah.
How does Kokai tie into that? Was there a connection?
Yeah, the piece suggests there was. It seems there were some as they moved clients over from their older system, Solimar, onto this new Kokai platform.
Oh, transition pains.
Pretty much. That kind of major platform shift can cause temporary disruption. So the article implies that might have contributed to that weaker Q4, but the Q1 results suggest they're getting past that now, and the benefits are starting to show.
Okay, that tracks. Big tech upgrades rarely go perfectly smoothly. But the company didn't just wait for things to smooth out, did they? The article mentions they responded actively to that Q4 result.
They did. Took it seriously. The article says they did a reorganization pretty quickly. The aim was to become more nimble, more agile.
To react faster.
Yeah, and to better position themselves to grab on to these new opportunities popping up in the ad market.
And what specific opportunities are they targeting now?
The article calls out three main areas. Connected TV, or CTV think streaming services. That's growing fast.
Right.
Then there's retail media, which is advertising on retailers' own websites and apps.
Like ads on Amazon or Walmart's site.
Exactly. And also audio advertising, podcasts, streaming music, that kind of thing. Also a big growth area.
Okay, CTV, retail media, audio. Makes sense. The CEO, Jeff Green, he's quoted in the article too.
Yes, he is. And he sounds, well, pretty optimistic. He talked about the positive effects already showing from those strategic changes they made back in Q4.
Implying those changes helped drive the Q1 beat.
That seems to be the implication, yes. He also expressed confidence they can keep growing faster than the overall ad market and, deliver value for advertisers who want data-driven, transparent ad buying.
One thing that really jumped out at me from the summary was the customer retention numbers.
Ah, yes. That's a really strong point in their favor, according to the article.
What were the numbers again?
Consistently above 95% retention for the last 11 years straight.
Wow. 11 years above 95%.
Yeah.
That says a lot about how much their clients value the service, doesn't it?
It absolutely does. It suggests a really sticky platform and a strong underlying business. Even when they hit, a rough patch like that Q4 miss, that loyalty is a huge asset.
Definitely. So looking forward then, what's the outlook according to the article? Did they give guidance for the next quarter?
They did. For the second quarter, management is guiding for revenue of at least $682 million.
Okay, and how does that translate in terms of growth?
That would be roughly 17% year-over-year growth.
17%. Still solid, though a bit lower than the 25% in Q1.
Right. But the article adds an important piece of context here.
Which is?
That the trade desk's management historically tends to be pretty conservative with their guidance.
Ah, the old under-promise, over-deliver strategy.
Kind of, yeah. Their track record, again, apart from that one recent miss, is generally beating their own forecasts. So that 17% might be a baseline.
Interesting point. What about valuation? How is the market pricing the stock now, according to the article?
It mentions the stock is trading around 34 times forward earnings.
34 times. Still sounds high compared to, say, the broader market.
Is, yeah. It's definitely a growth stock multiple. But the author contrasts that with its own history. Over the last 3 years, its average price-to-earnings multiple has been closer to 55.
55. Okay,
Yeah.
So 34 looks like a discount compared to its recent past.
That's the argument the article makes, yes. That relative to its own historical valuation range, it's currently cheaper.
And how did the market react immediately after this latest positive earnings report came out?
Very well. The stock jumped over 11% in after-hours trading right after the results were announced.
So investors clearly liked what they saw.
Seems like it. A sign of renewed confidence, for sure.
Okay, so wrapping this all up, it sounds like the core message from this Motley Fool piece is, despite that stumble, despite the market worry, the underlying story is actually quite strong.
That's definitely the takeaway, yes. The argument is that the Q1 rebound, powered by this Kokai AI platform gaining traction, plus their focus on growth areas like CTV, and underpinned by that amazing customer loyalty, it all suggests the trade desk's best days might very well still be ahead, not behind it.
A compelling case laid out in the article. It's certainly given us a lot to think about regarding the trade desk specifically, but also just the shifts happening in ad tech generally.
Absolutely.
So maybe here's a final thought for you, the listener, to chew on. As these AI-powered ad platforms like Kokai become even more sophisticated, how is that going to keep changing the game? What new opportunities or maybe even challenges does that create for the advertisers trying to reach us, sure,
Right.
but also for us, as consumers navigating this increasingly personalized digital world?
Yeah. It's a fascinating space to watch, no doubt. The evolution of AI in advertising is far from over.
Indeed. Well, thanks for taking this deep dive with us today.